So in this video, we're going to talk about different order types. Now, there are a few different ways that we can actually enter the market. The different ways we can actually trade are via market executions, buy and sell limits, and buy and sell stops. So a market execution is where we actually manually execute a trade. It's where we physically click a buy or sell button to trigger a trade on a currency pair in real time. So that is the way that I trade most of the time. Some people actually do use the orders though, the pending orders, more so. I personally think market execution is the most accurate way to actually make sure we don't get into losing trades, because we can wait and see if the market is really going to do what we want it to do. But sometimes there are times where the other orders can be very useful and can get some pinpoint trades. So we always trade via pending orders. There are two different types of orders, buy and sell. This is a market order that we can set up. To use the manual execution, because we can see, is the market turning over? Yeah, we'll get in a little bit later, but it does improve our accuracy. So that is a buy limit. Price comes down, taps the level that we set, and if it taps that level, we're triggered into a buy, hoping to then continue the buy. The sell limit is the flip side of that. We set the sell limit at an area above price where we are looking for price to tap into before it comes down. So if this happens, we're triggered in there, and we profit from the price for the same. Generally used for breakout trades. Now, I never actually trade buy or sell stops. I don't really see the use in them because of the way that I trade. A buy stop will trigger a trade, a buy trade, when price pushes through that level. So if we set this, say, above price, and then price comes and taps that level, we will be triggered into a buy. Okay, and then if price continues going, we'll profit from that move. Now, the flip side of that is a sell stop, where we put it beneath price, and if price pushes through the level, then we profit from all of the movement that happens past the sell stop level. Now, same kind of risk here. If we have a buy stop and the price comes up and forms this kind of movement, then we are going to get triggered into a buy, and then price will fall and we will lose. Now, on the sell stop, we trigger the sell stop, and then if price moves back up, we are going to lose money. So that's actually why I like to use the manual execution, the market execution method, more than these pending orders, because they do come with risk of just getting tapped in and then getting wiped out. You don't want to buy a level for it to just fall straight through. Same, you don't want to buy a level for the price to then just fall away. You need to see confirmation. Okay, so these can be useful sometimes, and we'll see how they are. I'll show you some examples of when we can use buy and sell stops, buy and sell limits. Well, probably not these, I don't use these, but these ones I will certainly show some examples of. But generally, we will be looking to market execute. All of this you're going to learn throughout the course, so don't worry. But these are the different order types for you to just get familiar with and get to know. So nice and short and sweet video. In the next one, we're going to talk about different trading styles and different time frames that we can trade on. This is quite an interesting topic, and something we'll definitely dig into, and then we'll pretty much be done and ready to actually get into the course. So hopefully you're enjoying the Forex fundamentals so far. Hopefully you've learned the basics of the market to this point at least, ready for us to actually move into the course and begin learning. So in this video, we're going to talk about different order types. Now, there are a few different ways that we can actually enter the market. The different ways we can actually trade are via market executions, buy and sell limits, and buy and sell stops. So a market execution is where we actually manually execute a trade. It's where we physically click a buy or sell button to trigger a trade on a currency pair in real time. So that is the way that I trade most of the time. Some people actually do use the orders though, the pending orders, more so. I personally think market execution is the most accurate way to actually make sure we don't get into losing trades, because we can wait and see if the market is really going to do what we want it to do. But sometimes there are times where the other orders can be very useful and can get us some pinpoint trades. So the other ways to trade are via pending orders. And there are two different types of pending order. There are buy and sell limits. This is a market order that we can set and forget, and price will trigger us into a trade when it bounces from a preset level. Now the other side is a buy or sell stop, and this is essentially the same. However, we are not looking for it to bounce, we are looking for price to pass through this level. So some examples then, because it might be a little bit confusing right now. Here are some little graphics of that. So buy limits, when price comes down, we have an order set at this level, okay? And what we're looking for is for price to tap that level, which will trigger us into a buy trade, and then for price to continue back up. So we do this at levels where we expect the market to reverse. Now they are a little bit risky because we are essentially buying into a drop, which means that if you have a buy limit set at this level and the market came down and just went straight through it, you're going to lose, okay? So this is why I actually prefer to use the manual execution, because we can see, is the market turning over? And yet we'll get... Right, so it's almost time to move into the course and actually start learning my methods and learning how to trade the markets. Before we do that though, I just want to conclude the Forex foundations that we've just spoken about and rerun over everything real quick. So, diving into it then. We've got a good indication of what trading is, okay? Forex is the name given to the foreign exchange market, which is a market where currencies are traded against one another. It's the biggest market in the world, the most market participants with the most money flowing through it. We have all the different market participants, institutional players like banks, hedge funds, and financial institutions, and trading firms. And then we also have people like us, the retail traders, okay? The individuals who are trading the market to look to make a profit. So the Forex markets are open 24 hours a day, 5 days a week. They close only for the weekend, and that is UK time. So depending where you are in the world, your time frame might be slightly different, but it's generally open throughout the week, and we close for the Saturday and Sunday. We can trade through the night, very flexible market, and while we can trade at any time, we do have a few trading sessions that are going to be the most effective. So trading through the London and New York session is where we're really going to make the most profits and get the most movements out of the market. The Asia session then will also provide us with some interest, and that is a late night session from 11 PM to 8 AM. So the market terminology that we need to know before we get into the course is going to be pips, which we've now spoken about. That is how we measure changes in currency values. Long and short, which refers to buy trades and sell trades. Confluences, which refers to a reason to enter a trade. Okay, so for example, we need multiple confluences to enter a trade. Volume and volatility, which refers to the amount of trading activity in a market, the amount of active traders who are there to buy and sell. Now, liquidity also comes hand in hand with this, referring to how many buyers or sellers are in a specific area in the market, how many orders we have waiting at a specific preset level in the market. So retracements also, before we move on to the next topic, are pullbacks in the market, okay? So if we have an overall uptrend, a retracement will be a pullback to the downside. So what do we trade and how do we trade them? Well, we know now we trade currencies, okay? We trade pairs of currencies, a currency cross. So a currency cross is something like this, like the Euro USD currency cross, where we get to trade the Euro versus the US dollar. We can both buy or sell a currency pair. When we buy it, we are looking for the first currency to trade higher than the second currency. And when we sell it, we are looking for the first currency to lose value against the second currency. So that is where these long and short trades come in. Okay. So we have two different main types of currency pairs. We have majors. These are the main currency pairs like Euro USD, USD JPY, GBP USD, and USD CHF. So these are the pairs that are traded the most. They have the highest trading volume and will provide us with the best prices, the best spreads and commissions. Now minors are also pretty much fine to trade. There are 14 of these minors, and we have some of the key minor trading pairs listed there at the bottom. So minors and majors are all we really want to trade. We do have exotics as well, but we don't really need to dive into those because generally the pricing is worse, the spreads are worse, and they are not so easy to keep up with. So back to recap on the long and short methods of trading. We can trade both ways. We can profit from price increases and price decreases. When we're trading, we want to measure profits in pips, which means we need to keep up to date with how to actually read these pips. Here's an example of a quote. We want to, as the general rule, go to the far right and remove the final decimal, and then we start from there with the 1 pip, the 10 pip, the 100 pip, 1000 pip, and 10,000 pip. However, generally we only need to measure 1, 10, and 100 because past that is very rare and large price movements. Another example here with Euro USD. We have different ways to trade, different orders, and of course market execution. So we can either wait for an order to be triggered, which would be the buy and sell limits and stops, or we can simply execute a trade in real time using a manual market execution. So there's a quick graphic re-showing the buy, sell, limits and stops. Right, so we have various different trading styles. Various different market participants trade in different ways. We've got scalpers, day traders, swing traders, and position traders. Now personally, as mentioned, I do recommend sticking to the day trading and swing trading approaches. We don't want to get too scaled in and start scalping the market, and we don't want to get too scaled out because we're going to be waiting months and months, maybe even years, to take some profits off the table. So this strategy that I'm teaching you is going to fit more so with day trading and swing trading. We don't need to put ourselves in one box and only do one, but these two are going to be the most effective with the methods that I'm teaching you. So there we go, we've concluded the Forex foundations. Hopefully you've got a better understanding of the